In this video, I'm going to explain and demonstrate how we would conduct an event study, and then we're going to use an event for Microsoft several years ago to see how they work and how we would download the information and use that information to make decisions. So what is an event study? An event study is a test that attempts to measure the valuation effects of a corporate event, such as a merger or earnings announcement, by examining the response of the stock price around the announcement of the event. The main requirement of event studies is that the stock market is efficient. That is, that stock prices react quickly and accurately to new information. Event studies are kind of seen as a joint test of both market efficiency and whether or not an event actually impacted the value of a firm. So what are they used for? We use event studies for determining how a proposed policy, acquisition, etc. would likely affect the value of the firm by examining similar events in the past. So, for example, if we wanted to determine how an acquisition might impact the value, the stock value of the acquirer and the acquired firm, we can look at historically what happened with similar acquisitions in the past. We can also evaluate how a previous event affected the value of the firm. The timeline of an event study looks like this. The interval T0 to T1 is the estimation period. For us, this is going to be about a year. The interval T1 to T2 is the event window, and this is a 6-7 day period, sometimes a little bit more than that, around the actual event date. And then finally, T2 to T3 is the post-event window, and this can actually be over several years. So the estimation window is used to determine the normal behavior of the stock market factors. Most often we use the market model, and the market model is that it's the returns for the firm are equal to some intercept plus the beta, the relationship between the returns for the firm and the returns for the market, to determine the normal behavior. We use that information then to determine, as we'll talk about soon, abnormal returns. For the event window, we use the data from this time period in conjunction with the intercept, or the alpha, and the beta of the stock or stocks to determine whether the event announcement was anticipated or leaked, so we'll look a few days beforehand, and the post-announcement effect, how long it took for the event information to be absorbed by the market. Sometimes we'll even see a reversal, where we had on one day a significant response in the stock market to an event, but then it turns around a day or two later as market participants realize that they overreacted. Finally, we have a post-event window, and that's used to investigate longer-term company performance following the event. So the regression of the market model looks like this. We have a single-factor model that says the returns for the firm are equal to some intercept plus the beta multiplied by the returns for the market. We can use that to estimate the abnormal returns and the cumulative abnormal returns around the event date. The abnormal return is the difference between the firm's actual return and the predicted return on a specific date. It's computed using the following equation. The abnormal return is equal to the return on a specific date minus, and then we have our intercept plus our beta multiplied by our returns for the market. The cumulative abnormal return is the measure of the total abnormal returns during the event period. It is calculated as the sum of the abnormal returns during the event period. So we'll get a bunch of numbers, and we need to determine whether or not those returns around the event date are actually statistically significant, or if they're just due to random error. So we'll test to see if the ARs are statistically significantly different from zero. That is, do the ARs indicate that the event had a real effect on the price of the firm's stock? The test statistic is the abnormal return divided by the standard error of the predicted y value for each x. In Excel, the denominator, that's the standard error, is calculated using the STEYX function. If the absolute value of the test statistic is greater than 1.96, so it could be greater than positive 1.96 or less than negative 1.96, then the AR is statistically significant at the 5% level. So what that means, what the term statistically significant at the 5% level means, that there is a 5% or less chance that that test statistic is due to random error. So there's a 1 in 20 shot that on that date that the test statistic or the abnormal return was due to randomness, and a 95% chance that it was due to probably the event that happened. So that's kind of our explanation of it. Now what I want to do is take a look at an actual event. It's a little bit dated, but it's one I like to talk about because it has implications for how companies make decisions. So on January 16th, 2003, Microsoft was the first major technology, internet or computer firm to announce the initiation of a regular dividend. The announcement of a dividend increase usually receives a positive reaction in the marketplace, so stock returns go up, as it communicates increasingly stable income to investors. Likewise, the announcement of a dividend decrease usually results in a significant negative return on the date of the announcement. What I don't have in here is that a dividend initiation can have a mixed response. Sometimes it's a positive response, sometimes it's a negative response. A little bit more information about this situation was that at this time, Microsoft had a lot of cash and a lot of liquid assets. Their cash and near cash assets were worth about $76 billion. So there was some pressure from some investors to start getting rid of some of that cash. So that's what we're going to look at today is how did investors react to this information? So our event date is our announcement date, and that was January 16th, 2003. Our event period was 2 days before that because that information could have gotten out a few days early. Through January 21st, 2003, the dates here are 5 days apart because there was a weekend in there. So that's why there's a week-long event period. The estimation period is for the previous year, January 15th, 2002 through January 13th, 2003. So now what I'm going to do is open up Capital IQ. And I'll show you in Capital IQ how to download the information. So I'm here in Capital IQ, and I want to look up first Microsoft. So I can type in here MSFT, that's their ticker symbol. And I'm in Chrome right now. In the other browsers, Internet Explorer and Firefox, this is going to look a little bit different, but I'll explain to you how you can get to where I'm at. So if you click on Chart Builder, you're going to get the chart. If you're not using Chrome, it's going to look a little slicker here, and I'll explain to you what's going on. Capital IQ uses Microsoft Silverlight to generate the new charts that are out there. This is the classic view. But in those other browsers, you can actually choose classic view, or you don't have to. The setup's pretty similar between the two. Let me demonstrate here. All right, so now I'm in Internet Explorer. I go to Chart Builder. And my chart looks a little bit different. I can go to the classic Chart Builder. It's right here. Pull that up. And so this is identical to what is available in Chrome. I prefer this one. You don't have to use this one. You can use the other one. We're just using this to get the information for the company. So I'm going to go to Custom because I want a specific selection of dates. So my first date is going to be January 15th, 2002. So I'm going to select from 1/15/2002, and I want to go through the end of the event period. The end of the event period is January 21st, 2003. I have daily. I want daily. Everything else looks good. I'm going to update the chart so we can see what's going on here. And then I'm going to download this information by selecting the Excel icon there, and it downloads my chart. my Excel chart. Looks like this. Enable the editing. You can see the first tab is just the charts. We actually don't need those. I'm going to take that out. The next table is worksheet is what we need. It's the chart data, it's the prices and the dates. And then the last one is the volume on different dates. We don't need this either, so we'll take that out. What I'm going to use for the market return is the S&P 500, and you need to look this up separately. If you put them on the same chart, what you'll end up downloading is a percentage change in both of their prices from the first date that you have on the chart till whatever date you're looking at. So it's not very useful. So I'm going to put S&P 500 in here. It's going to give me the ticker an up caret or an uptick SPX. So I'm going to select that. Okay, and it gives me the message here again. Again, if you're in Explorer or Firefox, you can select the classic view and you'll get to where I'm at. Select custom. Again, we're going to go from January 15th, 2002 to January 21st, 2003. Again, I have daily frequency. I'm going to update my chart. I'm going to download it now, again by selecting the Excel icon. It tells me it's chart 23. In this case, it's important that you select both. So I'm going to go to the second worksheet here, select both the pricing date and the share pricing. Because we're comparing an index to an individual firm, the dates don't always align, because as we see here, we see the value of the index on Christmas Day. Microsoft wasn't trading in the markets on Christmas Day, so we're going to have to make a little adjustment here. So I'm going to copy and paste this information. And our dates aren't going to align. Again, if you look right here, we have January 21st, 2002. That was Martin Luther King Day. And the Microsoft wasn't traded on the NASDAQ on that day because the NASDAQ wasn't trading on that day. So what I'm going to do is put a function in here to tell me if the two dates match. So I type in equals if the date for Microsoft equals the date for the S&P 500, then give me a 0. I don't need to do anything. If it's not true, if they're different, give me a 1 and it alerts me that I need to fix something. So those match, and what I'm going to do is just pull this all the way down for all my dates. See, you can see here there's several dates that the S&P 500 traded, or that we have a value for the index that Microsoft was not traded. So our first date here is January 21st. That would have been Martin Luther King Day in 2002. Delete that, shift the cells up, and then I'm going to pull this down again. Our next date would have been February 18th, 2002. I'm going to guess that was President's Day. You can see the value of the index didn't actually change on those days. So I'm going to delete that. Again, I'm going to grab here where the last 0 was and pull it back down. And I'm doing that because when we pull the dates up, it changes what's in the cell. And so it'll show it doesn't match anyway. This would have been Memorial Day, 2002. And again, we see that, I'm sorry, not Memorial Day, probably Easter. We see that again, there's no change in the index, but it's in the information, so we have to take it out. And I'm going down and taking that out. May 27th, that would be Memorial Day. I'm going to delete that, shift my cells up. Our next date is July 4th. Shift the cells up. Goes down. Our next date is Labor Day 2002. Shift the cells up. Take out that. The next one would be Thanksgiving 2002. The next date would be Christmas 2002. Almost there. The next date would be New Year's Day. And then finally, our last date is going to be Martin Luther King Day 2003. So now I've got everything aligned, all my dates match up. I can take out this row, or excuse me, this column, the pricing date for the S&P 500, and take out this row, this column. Now I can calculate my returns. But what I want to do first, I want to sort these where the most recent date is up here, because that's what we're interested in. We're interested in that event window. So I'm going to highlight everything by selecting the corner here, and then going to Data, and then Sort. And my data has headers, so select that. Sort by the pricing date, newest to oldest. And then it's going to give me the most recent date that we're looking at. And here's our event date is January 16th. So now we're going to calculate the returns for both. So Microsoft, the S&P, or I'm just going to put market in here. Our return for January 21st is equal to the price at the end of the day on January 21st minus the price the day before divided by the price the day before. And then I'm going to make that look nice by making it a percent. And drag that over here. Pull that down. Not to the last row here because it would just be an error term. Now I'm going to highlight my event period. So my event period is January 14th through January 21st. So that's what I'm interested in. I need to select this out so I don't include it in my estimation period. I'm going to pull that out like this, highlight it so I don't forget. Now what I want to do is calculate my intercept or my alpha, my beta, the standard error, STYX, the standard error, and then I also include the R squared just to get an idea of the explanatory value of the market model in this case. So I'm going to highlight these returns. Notice I don't include the ones in yellow, just the ones below it. I'm going to name this column MSFT. You can name it whatever you want. Again, I'm going to do the same thing here. I'm going to highlight that and call that the market. So you can run the regression using the data analysis, but it's actually a little more helpful to put it on the page here. The way you would calculate the intercept in this case would be equals intercept. Our y's, so our dependent variable is going to be the return for Microsoft, so that's MSFT. And then the independent variable is going to be the market return. I'm going to put in market and close parentheses. And it tells me the alpha is 0.00044. My beta, this is going to be my slope, equals slope. Our known y's are Microsoft returns. Our known x's are the market returns. So it's 1.281885. The standard error is STEYX. Our known y's are Microsoft. Our known X's are the market. And then our R square equals RSQ, Microsoft, market. And it's actually pretty high for an individual stock. The model explains 62.4% of the variation or the variability of Microsoft stock. So I have that information now. Now I can calculate my abnormal return for each day. I'm going to highlight this and name it alpha. And then I'm going to highlight or select the next cell down, and I'm going to name that beta. So my abnormal return equation says that the individual return on the day minus the alpha plus the market return multiplied by the beta is the abnormal return. Then I'm going to pull that down. We can see that so far there seems to be something going on here. The actual return for Microsoft on the 17th was negative 7.03%. A portion of that was explained by the fact that the market return also went down on that day. So the abnormal return, that part of the return that was not due to the market, was negative 5.28%. So the event date was January 16th. However, the announcement came out after the end of the close of the market on that day. So my abnormal return is in the first column there. The second column, I'm going to put in my test statistic. And the test statistic was equal to the abnormal return divided by the standard error. And I'll just lock in the standard error by pressing, I'm going to press the key F4. You can see the dollar signs in front of the H and in front of the 12, and that just locks it in for when I want to pull that down here. So you can see that it stays, the abnormal return changes in each of the cells, but the standard error does not change. My next column, I'm just going to say, is this significant? Question mark. So we're testing to see if it's significant. Remember, the rule was 1.96. What I'm going to put in here is equals if the absolute value of the test statistic is greater than 1.96, comma, well then yeah, it's statistically significant. We want to say yes. If it's not statistically significant at the 5% level, so we're going to say no. And so in the first case, it's not statistically significant on the 21st, but it is on the 17th. In fact, it's the abnormal return is quite statistically significant beyond that 5% point. And then finally, we're going to calculate the cumulative abnormal return. And that's calculated as being equal to the sum of the abnormal returns during the event period or the event window. So I'm just adding each day the abnormal return during the period. And so we end up with a cumulative abnormal return during the period of negative 3.92%. And really the effect we saw here, with a little bit of maybe a turnaround here, but not statistically significant, of 5.64%, 5.28% for the abnormal return, really kind of on the event date. So you might be asking yourself, well, why was the return negative? And that's because at the time, it was 2003, beginning of 2003, we were not too long in the past had gone through the big bubble burst for the internet and computer companies. And people who had been invested in Microsoft had really invested into a growth company, a company that was making a lot of profit and gaining market share in a growing market. And whenever they announced a dividend payment, what they were signaling to the market was that their amount of good investments were going away. They didn't have as many good investments. They were not going to be growing as fast as they had in the past. So they couldn't justify keeping all this money, all this cash on hand. So they started paying it out. In fact, they paid out a fairly large one-time dividend around the same time. So I hope this has been useful for you. Please let me know if you have any questions.